All right, let's talk about one of the most brutal earnings reactions we've seen this quarter, Portillo's. This wasn't just a bad day or a simple miss. This was the day the company's entire story for investors got a hard reset. So what on earth went so wrong? Let's dive in and deconstruct this thing. So picture this, August 5th, 2025. The market gets a look at Portillo's latest numbers, and bam. The verdict was swift and absolutely unforgiving. The stock just cratered, down over 23%. We're talking in a single day. Nearly a quarter of the company's value was just wiped out. And you have to understand, this goes so much deeper than just some disappointing numbers for one quarter. This was a fundamental shift. This was the day the music stopped, and the entire investment narrative that Portillo's had been selling to Wall Street was forced to change. Even the CEO basically said it's a show-me story now. The time for promises is over, now they've got to prove it. Okay, so to really get our heads around that 23% plunge, we've got to start at the beginning. Let's look at the evidence, the actual headline numbers from the earnings report itself. Now here's where it gets kind of weird. You look at these numbers, and they don't exactly scream complete disaster, right? Yeah, revenue missed expectations, but their earnings per share, that was pretty much right on the money. The real clue, though, is buried in the details. See that positive same restaurant sales number? That's only positive because they jacked up prices. Actual customer traffic, the number of people coming through the doors, was down. So a mixed bag for sure, but still, does that justify a 23% crash? And that really is the central question here. If the quarter that just ended was just a little soft, maybe a little disappointing, what caused Wall Street to hit the panic button so hard and trigger this kind of massive sell-off? Well, the answer wasn't in the past. It was all about the future. The market wasn't really reacting to the results they just saw. They were reacting to the deep, deep cracks that management revealed in the very foundation of their growth story. Yep, let's be crystal clear about this. Investors weren't selling based on Q2's performance. They were dumping the stock because of management's absolutely brutal forecast for the rest of the year. Those Q2 results were just the appetizer. The main course of bad years was yet to come. And this right here, this is the smoking gun. It was a total bloodbath. Management took a knife to their full-year guidance across the board. Same restaurant sales, which they had previously promised would be up 1 to 3%, got slashed to negative 1 to 1.5%. That is a gigantic swing. On top of that, they cut the number of new stores they're planning to open from 12 down to just 8. It was a complete surrender on their previous growth promises. And just so we're all on the same page, same restaurant sales, or comps as you'll hear them called, are the lifeblood of a restaurant growth story. When you see that number flip from positive to negative, it sends a terrifying signal to investors. It means your core established business is actually shrinking. It's a massive red flag. Now, this guidance cut didn't just come out of nowhere. It was a direct result of some very real problems that management had to fess up to on the call. You've got declining customer traffic. New stores, especially in their key growth market of Texas, are ramping up way slower than expected, and the whole industry is caught in this vicious value war with competitors slashing prices. All of this, by the way, is happening with an activist investor, Engaged Capital, breathing down their necks. And this whole situation in Texas really shines a spotlight on their execution problems. After the activists started making noise back in March, management ran a big marketing campaign. But then they admitted they overcorrected and pulled back too hard on marketing because the initial openings were so chaotic. So what's their new plan? They're going to send a beef bus to high school football games. It just highlights this really difficult and expensive learning curve they're on in a market that's supposed to be their future. So, okay, facing this onslaught of bad news, what's the plan? Well, management really had no choice. They had to pivot their entire strategy and their entire message to Wall Street. The CEO, Oson-Lew, said it himself, and this quote, it signals a massive strategic shift. They're moving away from the old story of growth at all costs, open as many stores as you can. Now the focus is much more disciplined. It's about making sure every single restaurant is a highly profitable machine first. So their new game plan really has 4 pillars. First, sharpen those unit economics. Make every restaurant a cash machine. Second, slash the cost to build new restaurants to make future growth more profitable. Third, lean heavily on technology like kiosks and AI to drive efficiency. And fourth, finally figure out Texas and get that market right. And to be fair, they are making some real progress here. Just look at the build costs. The average new restaurant they built in 2024 cost about $6.8 million.
For next year's class, they're targeting a cost between 5.2 and 5.5 million. That is a significant saving and a clear sign they're serious about this new discipline.
Technology is the other big lever they're trying to pull. Kiosk adoption is already over a third of their in-store orders, which is great because it tends to boost how much people spend. Their new loyalty program has signed up almost 2 million members just since March. And they're even testing AI in the drive-thru. These are the tools they are desperately hoping will finally turn that negative traffic trend around.
Okay, so the company has identified the problems, and they've laid out a new plan. The million-dollar question now is, will it actually work? So let's break down the analyst's perspective. So right now on Wall Street, you've really got two camps. The bulls will tell you that this new discipline is exactly the right move for the long term. They'll point to that cult-like brand and the new tech as the way they're going to reignite growth. But the bears, they're laser-focused on the execution risk, especially in Texas. They'll argue that in a show-me story like this, the market won't give them any credit until the numbers actually prove the turnaround is for real. So with all of that in mind, what happens next? Here's what we're going to be watching for on their next earnings call. Well, management already set the bar pretty low for Q3, guiding for same-restaurant sales to be down again. We expect they'll probably land right in that range. Because of that, the stock is likely going to be range-bound, basically stuck in neutral, as investors wait on the sidelines for real proof. The one metric that matters more than anything else, any sign at all, that performance in those new Texas stores is starting to stabilize. And for all those reasons, our rating on the stock is market perform. Look, the pivot to smarter growth is absolutely the right long-term strategy. But the headwinds from declining traffic and the massive risk that they fumble the Texas expansion are just too high to be bullish right now. They're in the penalty box. And finally, let's talk about our outrageous but plausible trade idea. You could go long the stock, betting on the turnaround, but hedge that position by buying long-dated puts. Think of puts as an insurance policy that pays out if the stock falls. This setup gives you upside if they pull it off, but protects you if they fail. And the ultimate catalyst for that insurance policy? If this turnaround doesn't show real results by mid-2026, you can bet that activist investor Engage Capital will lose patience and try to force a sale of the entire company.
This is not financial advice.